All right, so today's planning topic. So we're going to follow the same format we always did. I guess some good IRA distribution updates. And my goal for these updates from the Slott group is sharing with you the material that I read throughout the week, in this case, weeks, and that I find helpful with not only how we handle our clients in our practice and constant education, but just for awareness for you folks, because we still see it, all the time. I hear it from, I had a conversation with a fellow advisor last week when I was in Gainesville. We were sitting at dinner and we were talking something came up about required minimum distributions. I don't remember who brought it up, but this financial planner, financial advisor was completely unaware of a very strict rule about required minimum distributions. And I don't recall what it was. It might have been the conversion, not doing a Roth conversion before required minimum distribution is taken. And I'm always surprised, right? So I think of these as basic things. And I thought to myself, my every week listeners would know exactly about this issue. But this education is very, very important. And although you're not professionals, financial professionals, it's good to know for your own planning and your own awareness. Because first of all, if we bring it up to you, you'll remember, oh yeah, that's right. I remember that now. Or maybe we just avoid the problem altogether. So that's my goal for you with these Slott updates. We'll talk about the markets a bit. So the markets are really taking off today, but that's based on some headline news that we're going to discuss. And then we're going to have a financial planning topic. And then the financial planning topics today is optimizing your investments and retirement income. So this is going to be familiar territory for you, but again, a very, very good review. All right, so let's talk about these headlines. So the big headline today, of course, at 8:30, the Bureau of Labor Statistics released the Consumer Price Index report for November, and for November, and it rose 7.1% year over year, or 0.1% for the month. So that's, believe it or not, good news. If we look back at this recording 2 years from now, or maybe even a year from now, and you just caught that, hey, the Bureau of Labor Statistics released CPI data that inflation's up 7.1%, you think, oh my goodness. And certainly if we were forward looking, if we would have been able to hear that from 2 years ago, we think, oh no, things are horrible. But we see it as good news now because the expectation was 7.3%. So coming in below that at 7.1%, of course, is better, particularly because there's the Cleveland Fed was predicting the number to be at 7.49%. So the markets are reacting positively. We'll see how long that lasts. Now, I don't expect that to make any changes to the way that the Federal Reserve is planning on raising rates. They've been, I think, very clear about that. So I think we can continue to expect aggressive rate increases as they had stated. So overall, good news. Everything still costs way too much, way much more than it did last year. I'm planning on doing a piece of prime rib for Christmas, and I just can't wait to see what that's going to cost. So let's go into the Slott report. I'm going to share my screen with you. So just stand by a moment. So you'll see that this came from our previously scheduled webinar back, I guess it was the 29th, as I said. So this is from Monday, November 28th. And I liked this bit here because it's random real life questions and answers. So again, just raise your hand for me if you can see my screen. Okay. Can you read along with me? All right. So, so this is from Andy Ives. You've met Andy, I believe, but each day we receive dozens of retirement related questions. I'm right here from advisor members of the Ed Slott IRA advisor group. Conversations range from incredibly complex to obscure to I just needed to confirm what I was thinking. And I have to tell you, so first of all, yes, we send them complex questions. They come back with very detailed answers with typically IRS code backing it up. But this is what I benefit from so much with the Slott group. This is what I'm thinking. I just want to make sure I'm on the right track. And 9 times out of 10, that's the conversation I'm having with these folks. And it just, it gives me a level of comfort and foundation as far as the steps we're taking with our clients. So this is valuable. I just need to confirm what I was thinking. Whether a long explanation is required or a quick comment, our members have our undivided attention. We take every question seriously and proactively fill in any information gaps. Here's a random sampling of some recent communications. And somebody wrote, I was told by a very successful person that Roth conversions were ending. Is this true? Well, this is definitely not true. There was a proposal in the Build Back Better bill to limit certain Roth conversions, but those proposals never materialized. There are no limits on Roth conversions. Can a business owner contribute to both a SEP and a Roth IRA? So SEP IRAs are simplified employee pensions. That's what the acronym stands for. And they're for typically smaller companies, and usually just when there's the owner is the only employee of the company. Maybe it has, a spouse. So can a business owner contribute to both a SEP and a Roth IRA? Yes, participation in a SEP has no impact on whether a person can also contribute to a Roth IRA. However, you must still abide by the Roth IRA income phase-out levels. Okay, my client is being laid off in December. He turns 55 in 2023. Can he use the age 55 exception in his 401k? Now, I have to tell you, this is one I would have to go back to them on, because this is something that doesn't come up often, the age 55 exception on the 401k, but it's out there. It's good to know. And that's the kind of thing that it triggers something in the back of my brain, from my experience, my CFP studies, but not necessarily at top of mind. So they write, Andy writes, to leverage the exception, you must separate from service in the year you turn 55 or later. If he can delay his termination until January, then yes. If not, unfortunately, he will not be able to use the age 55 10% penalty exception. So that's just a way to draw funds out of your 401k early without triggering the 10% exemption, is the 55 exception in a 401k. All right, moving on. A 90-year-old tried to roll over his $1.9 million IRA in January. The bank erroneously put all the money into a regular brokerage account. He got sick and his son just discovered the mistake. So these things happen often, unfortunately. So let me read the facts back to you. A 90-year-old tried to roll over his $1 million IRA in January. The bank erroneously put all the money into a regular brokerage account. So that's considered a full distribution, right? They put it right into the brokerage account. He got sick and his son just discovered the mistake. Are we stuck with the distribution? They said not stuck. One of the 12 reasons for self-certification when the 60-day rollover window is missed is an error was committed by the financial institution making the distribution or receiving the contribution. So it happens so often that it is one of the 12 reasons for self-certification when the 60-day rollover rule is missed. So an annuity company paid out an IRA to my client that she inherited from her brother. She's an eligible designated beneficiary, so we can deposit that check into an inherited IRA for the stretch, correct? So a couple different things going on. An annuity company paid out an IRA to my client that she inherited from her brother. She's an eligible designated beneficiary. Can we deposit that check into an inherited IRA for the stretch? So sorry, no, they say. So they've determined that let me go back. They've determined that she is an eligible designated beneficiary, but there's been a distribution from this inherited IRA. Sorry, no, she might be the sister and an eligible designated beneficiary, but non-spouse beneficiaries cannot do 60-day rollovers with inherited dollars. So the difference there is if they would have just distributed the funds or transferred the funds directly to the inherited IRA, then the client could have done the stretch payments. So right now I'm here. My client did $150,000 Roth conversion. Now he is over the income limits to contribute to a Roth IRA. Is there any fix? This actually came up with a client of mine who had this question for me when we were helping them calculate their Roth conversions, and she was asking me about Roth contributions at all. So this is a happy answer. My client did $150,000 Roth conversion. Now he is over the income limits to contribute to a Roth IRA. Is there any fix? No worries. Roth conversions do not count against total income for Roth contributions. See IRS publication 590A, worksheet 2.1. This is an example of the responses we get with the tax code quotes. Modified adjusted gross income for Roth IRA purposes. This is something I've seen CPAs mess up. I've gotten calls. Well, you did a $200,000 conversion last year. They can't make a Roth contribution. If that conversion amount is the deciding phase out factor, right? What the thing that drives the income over, then that Roth conversion is not counted in that. It's not counted in the phase out level, which is great. It's really good planning from the IRS. I wish they had more of it. First and foremost, I wish they allowed until the tax filing deadline for Roth conversions instead of year end. So the next question, with the market downturn, my client has a lot of capital losses. Can we offset those? Can we use these to offset a Roth conversion? Well, no, only $3,000 of capital losses can be used to offset a Roth conversion. There's no difference. If you can't directly offset any capital gains with losses, then $3,000 a year can carry forward against any income, including Roth conversion, income that's created by Roth conversions. Other recent inquiries touched on successor beneficiary scenarios, year of death RMDs, and Roth 5-year clocks. We answer questions about excess contributions and expats as beneficiaries, trusts, 72T schedules, Roth conversions, NUA, pro rata, and how the 10-year rule works. We're all popular topics. Our members keep us on our toes, and we're happy to assist. All right, then a little pitch there to join the advisor group. Now we're moving on. I don't see any questions. Now we're moving on. Roth conversions and required minimum distribution. So this is from last week, or maybe 2 weeks ago. No, last week. And again, by Andy. Andy's a busy person. The question is, hello, Mr. Slott. I've been doing Roth conversions this year from 2 small accounts, one a rollover IRA and the other a SEP IRA to consolidate into fewer accounts. The small SEP IRA has been drained this year, taken everything out of it in 2022 by converting the balance to my Roth. So we moved the entire balance to a Roth IRA. The rollover IRA was reduced by 1/3 this year, and the rest should be converted to the Roth in early 2023. My question comes from the fact that I will turn 72 in July of 2023, so I must begin RMDs in 2023 based on December 2022 balances. So just to remind you, when we calculate our RMDs, you've got to take a snapshot of the prior year balance, 12/31, in this case, 2022 balance. Then there's a calculation done using the lifetime expectancy table, which you can find on our website, that tells you exactly how much you have to take out of that, that IRA. If I finish draining, I'm here. If I finish draining / converting the rollover IRA in early 2023, will my RMDs be based on the 12/31/2022 balance? If I convert the balance in early 2023, will I still have an RMD? It seems unfair to be forced to take RMDs from an empty account based on the balance the previous year, but I can't find anything that says otherwise. Thanks in advance for any help you can provide. So what do you think? What happens here? So he's in early, he's done some conversions complete in one account and 2/3, I think he said, in the other account. And now he wants to finish that in 2023. And he doesn't want to take his RMDs because the balance in the accounts in the IRAs, traditional IRAs, will now be 0. But at the end of the year, they had balances. So what do you think the answer is for Carol? I said Carol. Well, I guess Carol could be a man's name. If you have a balance in the traditional IRA account on December 31st, 2022, then you have an RMD based on that value in 2023. RMDs cannot be converted, so you must take the 2023 RMD before you continue with your conversion schedule next year. Even if you want to pay taxes on everything and convert the entire remaining balance, you must take the RMD first. The RMD cannot go to a Roth. That's what you have to remember. And in this case, Carol would be taking that RMD. Let's say it's $1,000 and she would be moving it to the Roth, and you can't do that. You take it out, you can spend it any way you want, but you can't put it in a Roth. Even if you want to pay taxes on everything and convert the entire remaining balance, you must take the RMD first. That RMD cannot be rolled over or, as mentioned, converted. The only way to avoid a 2023 RMD on those dollars is to convert everything before the end of 2022. I think this is the last question. Yes. Can the sum of RMDs for more than 100 traditional rollover and inherited be taken for more than one? Let me read that again. Can the sum of RMDs for more than one IRA, traditional rollover inherited, be taken 100% from an inherited IRA? So this is that aggregation question. For example, with a $10,000 RMD for a traditional IRA, a $5,000 RMD for a rollover IRA, and a $1,000 RMD for an inherited IRA, can the entire $16,000 sum of RMDs be taken 100% from the inherited IRA only to satisfy the RMD requirements for all three IRAs? Thank you, David. David, sorry, no. There are rules governing the aggregation of IRA RMDs. So this is a really common area where people get stuck. You can aggregate certain accounts. You can't aggregate other accounts. They just think logically, I should be good. Logic has nothing to do with anything. This can go on for years. You have missed RMDs and the penalties are really big. Some accounts can be aggregated for RMD purposes. Some cannot. In your scenario, the traditional IRA and the rollover IRA are essentially the same thing. Both are just traditional IRAs. The RMDs for those two accounts can be aggregated and taken from one of the traditional IRAs. The inherited IRA is a different type of IRA that cannot be aggregated with your traditional IRAs. The RMD from the inherited IRA can only be taken from that inherited IRA. And that the other common issue we see are retirement accounts. You cannot aggregate IRAs and retirement accounts. All right, so that is the Slott report. I'm just finding my notes. My face popped up in front of my notes. That's no good. This is a report from BlackRock. Well, I got to find my market report first. All right. So looking back last week, so I was really disappointed. My Invesco report that I always get it just never came in. Didn't come in yesterday. Didn't come in today. So I'm using this snapshot from Empower, which is fine. It's just a different format. So last week, so as a close of business, whatever that was last week, let me tell you, 12.9. The Dow Jones and just your average, they were down 2.77% for the week, 7.8% for the year, 7.88% for the year. The S&P 500 is down 3.37% or 17.45% for the year. NASDAQ is down or was down 4%, 3.99%, and still down just about 30% for the year, 29.66%. So Russell 2000, which is small size companies, was down 5.08, and nearly 20% for the year. And as you've heard me say so many times, most frustratingly for most folks, the bond markets were down again last week. The Bloomberg U.S. aggregate bond market, where most people's bond funds sit, was down 0.5%, almost 0.44%. And still down just about 12% for the year. So that's what individual investors are having a hard time getting their heads around, that these bonds are supposed to be my safe alternative are down. So that's frustrating. We'll see what happens with the CPI report. What I expect is a lift today, maybe even for the rest of the week. But, folks, my feeling when we're being honest and we look back, we've been in a recession for some time. It's going to get much deeper next year. We're still wading through this blog. I don't know if that's the right term now. Blog thinks I'm thinking like swamp. But now I say blog and I'm thinking like, the web blog. But it's going to be a tough go over next year and a half, 3 to 5 years. So don't let one positive CPI report drive you to start thinking the market's turning around. It's going to be a while before we have some real solid footing here. Not that you should just be on the sidelines. We should be looking for opportunities and staying invested where it makes sense. So there are some potential opportunities out there. You of course want to stay active in your plan, but just don't get caught up in the hype. This report from BlackRock that I'm going to refer to was from a couple of weeks ago, but I thought it was very good, and I also thought it was about time that somebody was talking about it. So they were talking about the aging of our country and the rising cost of curbing inflation, the rising cost of inflation around the aging of our typically or especially our labor forces. So you've been hearing me say this for some time. What's different now, people say, if you look back to the Great Recession, the Depression, even 60s, 70s, what's different right now is we have this massive labor shift, people retiring, millions and millions of people retiring, and most working. If they're going to work, short-term, part-time. Most people who I talk to, we talk to a lot of retirees every year. I mean, no exaggeration. I probably talk to 100 families a year about, or more, I don't know, about retiring. But most people, if they're, they reach their retirement age, their plan isn't to work again. And if it is, they're going to work part-time, and they're going to work for a short period of time, 3 to 5 years. It's only folks that are really have to continue to require that tend to continue to work. So when you have that major shift, that workplace shift on top of very high inflation, even 7.1 is very, very high, not sustainable over the long term at all. Remember, the Fed wants to get us back down to 2. This is why I think this is going to be a long slog. 7 to 2 is significant. Now we kind of get a reset, as year over year, because we are coming out of a pandemic and inflation was very, very low. Costs were very, very low. Remember, dollar was $1.85, $1.83, maybe less a gallon. Now it's much, much higher. But what's different about this situation with rising interest rates, high inflation, is this labor market. Everything coming on, the age, I should say, right? The baby boomers. So people are aging into retirement, leaving the labor market, and that's one part of it, but also beginning to collect Social Security, beginning to collect Medicare. So not only do we have less people paying into those benefits, now these benefits the costs are much greater. So this is where these economic pressures are coming from. Forget about the effect of your tax rate. We know, all of us here know what that effect of the tax rate is going to be. It's going to, effectively double our taxes by 2030, we believe. But there's also a huge effect on the economics of our country. So that's really what's different now, and again, why I think we're going to be at this for a while. So BlackRock started to talk about that. Aging has worsened labor shortages, raising the cost of taming inflation. We see the Federal Reserve living with some inflation, so we like inflation like bonds, they said. Labor supply is a major factor in determining the recession cost of trying to tame inflation. That's why this week's jobs data, so that was a couple of weeks ago, are key to the Fed and the markets. All right. There was a good point, or a good piece from Empower, and they talked about the big banks, and to watch what the big banks say. So Bank of America and Morgan Stanley each took the stage on Tuesday to fret about the economy and hint at plans to slow hiring or even cut headcount outright. And this had to do with really, again, key economic data that they're seeing. And they write, longtime readers will know that banks occupy a special place in my heart, the author says, when it comes to all things macro, because they sit at the crossroads between the real and financial economy. So that's an interesting statement to me. So they not only read the economic data that we read, but they see it every day too. So they're very, very in tune with the economic data, but then they also see what happens with the consumers and the workforce, and they're obviously greatly affected by interest rates. So, because you have this issue with interest rates where you might think, well, the banks are going to prosper dramatically because interest rates are higher, but people also may borrow less we're starting to see a downtick in housing. You know, I get my Zillow reports every day because I'm always looking for real estate, and I've got different pockets that I'm looking for. But I'm starting to see prices come down. Even at the Jersey Shore, I'm starting to see prices come down, which we've seen nothing but significant increases over the past couple of years. So I thought that was an interesting take. And that was also, if I didn't mention it, that was from Empower. So the gist of the article is this had to do with the Fed again, right? So this economic data is any positive economic data, unless, you know, it's just a complete turnaround, is not going to affect the increases of interest rates. All right, so let's move on to our financial planning topic. And this week, I'm going to talk about optimizing your retirement income. So, you know, when I put this together, I thought about it quite a bit, and this is a thought I've had for some time. And I'm opening up my whiteboard. It seemed to have closed on me. So, if you're just joining us, actually, let me share my screen. Well, stand by. So I have a question. So Doug asks, hi, Doug, good to see you. Can you take an RMD for a spouse from my RMD? And then he answers his own question, I guess no. So what I like about this question is that you answered it, and I'm hoping that you answered it because Doug, you're one of the people that's on this webinar every week. And I think maybe when you started a few months ago, maybe you would have answered this differently. But now IRA accounts are individual retirement accounts. They're assigned to you. It's your tax number. You can't share those. The only way you can transfer money to an IRA is if you die, or from an IRA is if you die. So other than a qualified charitable distribution, that's a whole other thing. But the answer is no. You can't fulfill someone else's required minimum distribution out of your own IRA. Good question, though. Okay. Let's see here. What was I doing? No, sharing my screen. All right. So if you're just joining us, we're going to talk about optimizing your investments and retirement income. So you'll see the very familiar to you folks, the buckets here. So I'm putting my tablet down so I can draw on it. So you may see me looking down. And if you're just joining us on YouTube, because we do separate these, this is our financial planning topic of optimizing your investments and retirement income. I urge you to hit the subscribe, like, and notification buttons so that you'll always get updates on when we have new videos. So we're going to talk about where and how your investments should be positioned to make sure you're optimizing that income. Because isn't it really about this income? You know, we get so caught up when I'm reading financial articles throughout the weeks. A very common statement is, how much should you have in your accounts at what age? You know, at 40, it should be this. At 50, it should be this. At 60, it should be this. At 70, you know, whatever it is. The answer is, does it really matter? Well, of course, in some degree it does, but the amount of money in the buckets, when you're talking about income, doesn't really matter, does it? It's the income that is generated from it. So if you need $100,000 a year in income, and you have to adjust for inflation and all that, and you've got to plan on that, you know, let's just say 35 years, you need $100,000 a year. Well, if you're meeting your objectives, if you're getting your $100,000 a year, if it's adjusting for inflation, if it's doing all the things you need to do, if it's a combination of Social Security, maybe you have a pension, rental income, and your investments, does it really matter where it's coming from? So other than just maybe some people have a goal in mind, I want $3 million, I want $5 million. Most people aren't concerned about the dollar amount that's in any of their buckets or their total investments. They're concerned about this income. And if they're not, they should be. Because if you can derive $100,000 from $1 million, then do you really need to strive for more, take additional risk, etc.? Now that's a big number, right? You'd have to have a lot of other income coming in. I'm just using it as an example, but I just want to I'd love for the conversation to get away from how much money do you need to how much income do you need? And that's a fundamental kind of question. And frankly, the financial advisory world doesn't really like that conversation because they don't charge fees, or we don't charge fees based on income. We charge fees based on assets. So it's not in the big firms' benefit. I'm kind of getting on my soapbox here to say, hey, you really don't need $5 million. You need $3 million. You only need 3 million. 5 would be nice, but you really, let's just shoot for 3, because that's going to get your needs met. If they're charging 1% on your $3 million, they want to get it to 5, right? That's how they continue to make money. So, of course, it's our investments and our other income sources that drive this retirement income. So we do have to optimize where these investments sit. So let me just get that off of here. Why isn't that erasing? Goodness. Okay. So I hope that first part makes sense. But why do we do this? So we're going to talk about how things should be positioned in here, but why do we do this? So there are a couple of risks that we want to cover. First of all, we always talk about market risk. These are the kind of the 4 that everybody, first of all, it covers almost everything, and you really want to pay attention to. And I often will list these, and I ask clients to list them in order. And there are just 1, 2, 3, 4 here because that's how many there are. Everybody's got a different order. Your market risk might be 4. Your tax rate risk might be 1. Longevity risk, and I'll go through what these mean, but you might list these or as far as importance differently. So don't pay attention to that. But of course, market risk is what we've been experiencing throughout the year. We start at a certain amount of money, and because of things outside of our control, right, the general markets, we have less, right? So our $3 million is now worth $2.5 million or $2 million, depending on how you invest it and what your experience has been. So that's market risk. How long, or how are my investments going to respond to outside influences and things beyond my control? And we have longevity risk. Well, longevity risk is, if I'm going to be here till 90, I can't have my money stop at age 85 or age 89, right? So I can't have that income stop. Again, it's not about, well, I still have my $3 million. It's, well, I still have that $100,000 that I need adjusted for the inflation amount that I need. Because your inflation amount, just like your withdrawal amount, those different things that we talked about are might be different than others. You might have areas that you spend differently. You have your core inflation, but you might have your own kind of personal inflation number because you do things differently. And it might be higher or lower, but you don't want the money to run out, right? So while you're still here, and you can joke about this sometimes, but it's really serious. If you live to be 90, if you live to be 95, and that's when we project our average longevity is 95. I know that's well beyond what the tables and the government tells us, but that's what we feel comfortable with in our financial plans. But you want to make sure that your money's still going to be there at age 95. And then you have long-term care risk. So long-term care, of course, you've heard me talk about it. We had, guests, specialists on these webinars, but long-term care costs are enormous. They can draw down a portfolio very, very quickly. They put a lot of pressure on your heirs, or if you're a single person with no kids, it's even more important to have plenty of funds put aside because you're going to rely on others to take care of you. So that is, if you need a medical, if you need long-term medical care in the future, you have that long-term care risk. And then, of course, tax rate risk. We talk about tax rate risk a lot. We believe that taxes are going to be essentially doubled by 2030 for most of middle-class American, for sure. But we have to cover that tax rate risk. So your order might be different, but these are the whys, right? We want to cover these risks. So we have to optimize your accounts, your investments, not only to make sure that we're taking the distributions from the right places, but we're also managing the risks around all of these. And we talk in many different ways about how we do that, but we're going to just go over the buckets today because we want to optimize for, of course, cash flow and any estate planning that you have. So we know then you've got your 3 buckets. So we know the taxable bucket, right? Anything you get an annual 1099 that's not retirement related. And you see these for interest, dividends, capital gains. And these can be long-term gains or short-term gains. We talked about those a lot. And we're seeing those now. We have mutual funds that are significantly down for the year, but are sending out embedded gains. That's one of these, just kind of putting salt in the wounds. Geez, my fund is down. I'm getting these embedded capital gains, and but I've lost money throughout the year, and that stinks. But we're definitely seeing those. So sometimes capital gains are controllable, sometimes they're not, but interest, dividends, capital gains, we get that every year. And so we know that we want 6 months to 1 year of expenses in these buckets, or excuse me, in this taxable bucket, because if you have more than that, you risk having money pushed out that creates a 1099s on these interest, dividends, and capital gains that is going to cause this amount of tax that's unnecessary, right? It's cause your Social Security to be taxed if it's not already, or taxed at a higher tax rate. It's just something that is often not controllable. And unless there's some estate planning to do in this area with passing high valued positions, with a stepped up in basis, then you want to keep this to a 6 months to 1 year of expenses. In tax deferred, we know that for some people, you can keep an amount that creates a required minimum distribution that is less than your standard deduction. And if you can do that, then your RMD can be tax-free. Now, that gets complicated. And I'm not going to get into that right now. But for some people, that's as much as, I've seen $250,000. Sometimes it's $100,000, and often it's $0, but it all depends on your situation. And then, of course, we say that everything else, right, should be in this tax-free or tax-advantaged bucket. And there are only 2 things that are truly tax-free, and that's anything Roth 401k, Roth 403b, Roth IRA. We talked about Roth conversions. They are a process, not an investment, but anything Roth and some cash value of life insurance. So there are ways, of course, to move money from here, and we're doing tons of it now, from tax deferred to tax free, and we use Roth conversions to do that. And that's a very precise calculation that we do every year for our clients. And if you're doing it yourself, you should be very, very careful of how you do it, because you don't want to trigger certain things that you're not aware of or you're not planning for. But you do want to make sure you fill up as much as you can that optimum tax bracket, which for most people is 24%. Sometimes it makes sense to go up above that. Sometimes it makes sense to be down below it. There is no one formula for everybody. It all depends on your situation. So you'll see here, these dollar amounts, and this is just a symbol here. So really this should be reduced a little bit. Let's take this down to a 2. Also, let's take this down to a 1, because you kind of want to think about, pouring what you need out of these buckets. Because let's go back to that $3 million number. So if you had $2,750,000 in this bucket, and you had, let's use 250,000. Now let's use less. Let's use $100,000 here. Let's say you could keep $100,000 in your traditional IRA, and your $100,000 would produce a required minimum distribution that is about $3,000, right? Maybe a little bit more. Let's call it $4,000 in the first year. Close, very close to that. So that is well below even an individual standard deduction. So that leaves some flexibility. So then you, absent any other income, you wouldn't pay any tax on that required minimum distribution. And absent any other income, it wouldn't cause your Social Security to be taxed. And then let's say you have the remaining amount, 150,000 over here. So that leaves a little over 1 year of expenses for you. So that's a little bit more, you know, we're back on this $100,000 a year. That may or may not be your number, but let's just use it as an example. So again, whether it's $5 million or $3 million, or if you could do it with $2 million, you could produce $100,000 and it's funneling from the right places and you're minimizing your tax liability. Does it really matter what the large number is? I don't want to say you shouldn't, you know, if you have $5 million, give it away. I'm not saying that. I'm trying to ease the pressure of either getting back there or getting to there, because this should be our focus. How do we get here? What's our need? Of course, if you have goals to pass it to your heirs, that's really commendable and it's a great thing and it's nice to be able to do. I hope I can do that for my kids one day. But most people, the large majority of people, come to us and then we ask them about their estate planning and they say, whatever's left, I want to make sure whatever's left passes to my kids as much as possible, but I want to make sure that our needs are taken care of. And what are your needs? Your needs in this example are $100,000. So if we're smart in our planning and we look at it every year and we make adjustments along the way, and we optimize where our money sits every year. We make adjustments here. You might look at this in a year and say, hey, you know what? $50,000, that's too much sitting here. We've got to have a plan for drawing that down. This $100,000 might be great for a married couple, but it needs to be shrunken down when one spouse passes. I say when I was at this presentation in Gainesville, there is an advisor giving a presentation. He was talking about the difference between the married rates and the single tax rates. And he said, and he kept saying, if one of your spouses, or if your husband or wife dies, this is what happens. And I raised my hand and I say, why do you say if? He said, well, what do you mean? We all die. So we have to prepare clients for the fact that it's going to happen. Very, very rarely do husbands, spouses pass at the same time when they're over 60, 65. The statistics get much, much broader. When you're younger, your statistics are that you're more likely to pass together. But obviously, as you get older, it changes. So very, very rarely. I mean, sometimes, men sometimes go soon after wives pass, but it's not often at the same time. So we're going to pass, and you've got to plan for that. So even for a married couple, 100,000 might be the right amount, but it may make sense. And I always tend to plan, right, with the idea that it's going to be a single filer at some point, and I don't want my single filer to have too much money in that IRA. I'd rather do that conversion, get it moved over, so that we are looking at tax advantaged or tax-free assets. Because if we can eliminate these or minimize or adjust these risks every year, we have to look at things that are out of our control and try to take it in our control as much as possible. So we can handle market risk by rebalancing our assets, using principal protection, using account segmentation. We do have answers to these things, but the markets are out of our control. Our decisions for our investments are not. Longevity risk, well, we can handle those things as well, right? Proper planning, making sure we're invested the right way and making sure our assets are in the right buckets, because if suddenly the amount of tax that you're paying here is zero and you've prepaid all your tax out of here, well, you're going to need less money from your Roth IRAs, aren't you, than from your traditional IRAs. You know, I had a conversation with somebody and they said, wow, that amount that's coming out of the traditional IRA to do the conversion to pay the tax seems much higher than 24%. Well, it is in total, because you're paying tax not on the $200,000 that you convert, right, as an example, but the $300,000, this is just an example, that you're distributing to either pay for cost of something else that you need, the tax on a distribution. So this might be 24% on $300,000, but it's a much greater percentage on the 200,000. I hope that makes sense. And so that not only has an effect during conversion, but of course it has an effect during distribution, because the big question is, of course, what's going to happen? What's the future of tax rates? And nobody wants to pay tax at the I don't know tax rate, because we're certain that's going to be higher. So when we talk about optimizing your investments for retirement income, it is simply having your funds in the right buckets so that regardless of the amount of money, you're getting the income that you need. So going back to this number as an example, and you shouldn't really care where it comes from as far as the dollar amount. You should care where it comes from here, because that's going to maximize your drawdown. That's going to maximize your funds. That's going to maximize the longevity risk for sure. Not maximize the risk, but help handle that longevity risk, because we've seen just by, and I've shown on these webinars through a financial planning process, you know, we take a sample client who's at a deficit, and just by changing their investment structure, we gain them X number of years. And then by doing Roth conversions, we gain them another X number of years. And often it's 7 to 10 years. So that really helps manage that longevity risk. Long-term care risk has to be managed a completely different way. But, you know, that, of course, can just destroy, you know, years and years of planning, savings, all of that. So it has to be addressed. And of course, tax rate risk. So it's very important, vitally important, to know exactly where these funds should be in your buckets, and how they're drawing out of these buckets, and what that tax rate is going to be. Because you got to hit this goal. You don't want to, you know, you don't want to be 5-10 years in your retirement and say, oh, well, I can only take, or I still have to take $100,000 a year. And now my 100,000 is really only buying me, you know, $80,000 worth of goods, services, gas, food, breads. We don't want that. We want to have this continue to grow for you. And there are ways to do it. And you can see, I hope, that optimizing where your money sits is very, very important. And I have to say, because we're in Roth conversion time and people are dealing with things like paying taxes, and, you know, they're looking at their IRMAs and all that, you've got to just stay the course. And it's important to have these conversations year over year, over and over again, just to keep on top, see the value, because it is, you know, often when I'm first talking to people about the benefit of Roth conversions, we talk in dollars. Well, if you do this a little bit differently, just making changes to how you're paying your tax and where you're positioning your investments, it'll be $2 million more at age 85, or $3 million more at age 85. But as I said, as we started this, it's really not about that, is it? It's about addressing these risks, the 4 risks that I went through, for sure. Because that's that sleep at night, making sure you're all set up. And folks, you have to sleep at night. You have to sleep well at night because of your own issues, right? And your own concerns and your own planning. Well, I've got to do that for all of you, right? So I want to make sure I'm sleeping well at night too, because the things that really wake me up in the middle of the night is a failed plan. So I had to make sure that you're all in good shape as well. And I lost my train of thought there, but it's really about where the income comes from. Unless your goal is to leave a sizable or a certain estate to your heirs, That's something that's important too. So we should pay attention to that. But that can also be a separate issue, because even if that's the case, oh, and that's where I was getting to, was I often talk about the dollar amount, but it really has to be about, the income goal. If your goal was a state, well, that's kind of simple, right? So let's go back to that $5 million number. When this goes back to account segmentation, you've all seen this before. We've got your time, 0 to 3 years, 4 to 6 years, 7 to 9 years, and so on. What we usually end up with is this legacy longevity column. And that just means this is money that you're not going to need during your lifetime. If you need it, it's there. If you don't, you pass to your heirs. Well, out of that $5 million, for example, there might be $2 million sitting here. Well, that goes back to the same fundamental issue. Well, now we have $3 million here. And we need to do what? We need to create income for your retirement. So over the next 35 years or 30 years, whatever your lifespan is going to be, it's not just a wish list. We hope this goes well, from the time you retire till the time you're no longer here. We've got to develop a plan for each segment, in each portfolio. You've seen me do this a million times. Each portfolio, or a portfolio for each segment of your life, and then you can vary it down. But it's the same thing. You just need to identify. So and sometimes that'll help ease your concerns too, is I feel like I have this $5 million number. I read it in Forbes that I should have, $3 million by the time I'm 65, whatever. That's not your number, first of all, and it doesn't matter. What matters is the amount that you can live off of that, and if that fits your needs, goals, and issues. So I hope that all makes sense. I'm way over. It's 10:59. I hope that was beneficial. I'm really looking forward to seeing you all in the new year, on the new format, in the new studio. If you need something immediately, if you're a client, please reach out. If you're not, we're happy to hear from you as well. But I wish you all a great rest of December. I wish you all a great rest of 2022. Looking forward to seeing you all in the new year. And so I wish you a happy new year, but I'll see you in early January. Have a great day. Have a great week, and have a great rest of the year. Take care.